All right, so today we have Ben Reynolds from SureDividend.com on the channel. Thank you so much for joining us.
Absolutely. Great to be here. Thanks for having me.
So, Ben, you're the CEO at Sure Dividend, correct?
Yes, that's right.
And you guys have been supporting the channel for a couple of years now. And those who've subscribed to this YouTube channel, they know that Sure Dividend provides those high quality income securities for folks, financial freedom and retirement portfolios. This is great information that people are looking for.
Thank you. I appreciate it.
You're welcome. I read it all the time. So
Yeah.
I guess, if someone is looking to start investing in dividends, right? Let's say they have a brokerage account with $0, or maybe they don't even have a brokerage account at all, but they know that they have to get started investing in dividends for either for their future or perhaps for their current needs. Maybe start by talking to me about, what's a dividend and where does it come from?
Absolutely. So, in thinking about what is a dividend, I think it makes sense to start with what is a stock. We see the stock market and the ticker symbols, and they're green or red, and they're going up and down, and it kind of feels like a casino out there. And you don't really, there's not a real connection to what a stock actually is. And a stock is just fractional ownership of a real business. So if you own one share of Coca-Cola stock, you own a very small percentage of Coca-Cola. I think it's good to always think about stocks as ownership in a real business. And then from there, businesses hopefully are making profit. And as an owner, you're entitled to that profit. Now, you can't just call up the CEO of Coke and be like, hey, Coke, send me some money, please. It doesn't work like that. But the Coca-Cola company will pay out dividends. They'll pay out a portion of their profits as dividends. And that's what dividends are. They're a portion of the income that the company makes paid out to its shareholders.
So every shareholder who owns for instance, a Coca-Cola stock would then get paid on a regular basis. In Coca-Cola's case, it's quarterly.
Yes, that's correct. And like you said, Coke pays quarterly, and the majority of companies do pay quarterly.
Right. So every 3 months in your brokerage account, you're going to get X number of dollars, deposited in there. I suppose folks would be tempted to withdraw that money, right? I mean, if they have 100 shares of Coca-Cola, maybe, they might want to keep that money. I mean, is that something that you would advise?
I would say, especially if you're just starting out, no, because you want that money to compound in your account. So you can reinvest that money either into the company that paid it. And that's a lot of companies or a lot of brokerages have dividend reinvestment programs where that money will actually go back into the company that paid it. So you can build up more shares over time, and then those shares pay you dividends. So you kind of have a snowball effect going on. Or you can take those dividends that are paid to you and buy other dividend stocks that you might like and build your snowball that way.
Interesting. So how does one find, a dividend stock? I mean, they can go on Yahoo Finance, they can go on CNBC, they can find all of these different places. But how do you find a good dividend stock?
Yeah, that's a good question. So that's where Sure Dividend comes in. We do a lot of free research on our site, and we also have several premium services where we have a team of more than 15 people now who analyze over 850 income securities. All of that analysis, we boil it down into top 10 lists every month for our different newsletter services. And a great one for people starting out is the Dividend Ideas Plan. And that gives access to our top 10 Dividend Elite report and top 10 REITs report. And I think a big emphasis here would be the top 10 Dividend Elite report, which shows our top 10 favorite dividend stocks every month that have paid rising dividends for 25 or more consecutive years.
Right. So those would be the dividend aristocrats, I guess.
Yes, aristocrats. So another way to call it is champions. Technically, the aristocrats are only S&P stocks. So there's like 65 567 of them, something like that, where there's over, I believe, around 140 dividend champions. But yeah, it's the aristocrats or champions.
So these newsletters are included in the plans that you guys offer.
Yes, the Dividend Ideas plan is the plan that offers these two services, and it's our beginning level service, which is perfect for people starting out with dividend investing.
Great. And so you mean, so when you say starting out, how old should someone be before they start investing in dividend stocks?
Well, in a perfect world, you would have started when you're 0.
In the womb.
Yeah, but now is the perfect time to start. The longer you're in the market, the better. So, if you're 50 and you're starting at 50, that's better than starting at 70.
Mm-hmm. Right. So then you can take these dividends while you're still working and then have them reinvest so that you're buying more stock, getting more dividends and building up that snowball or nest egg so that you can have that. So you can be able to withdraw in retirement or have that income to withdraw in retirement.
Yeah, exactly. That's the way I think of it. The purpose of this ultimately is to have your work income stream replaced by dividend income when you retire. So you have enough money to pay your expenses from these dividend stocks.
That's a great point. Now, you mentioned that now is a great time to be investing in dividend stocks. You mentioned earlier also that right now it sort of feels a little bit like a casino. Stocks are down, quite considerably. At least 2022 was a very difficult year for investors, with practically everything being down. Why would now be a good time to be buying these stocks?
That's a good question. So one exciting thing about dividend stocks in particular is you get more dividend income based on the share price going down. So dividend yield is just the dividend per share divided by the share price. So if the share price falls, your dividend yield on new money you invest will rise.
Goes up, right?
Yeah, exactly.
Right.
So
because you're still getting that same, look, if you're getting $1 a share and it costs you a lot less, that share price goes down in value. As long as they still keep paying you that dollar, then that yield is higher.
Exactly. And the market was down on average about 20% in 2022. So you could think about that as you're getting 20% more dividend income by starting now versus at the beginning of 2022.
The stock market is, I've noticed this before, it's probably the only market where when things are on sale, people run. When I go to the to my my local food market, if something is on sale, I buy more. But psychologically, this is the only market where it's completely backwards. And when it comes to dividend investing, I can totally see that if a stock is on sale, if you have a good quality company like Coca-Cola, like PepsiCo, or Johnson and Johnson, or any of these companies, these are companies that are not going away, and they're fantastic companies with with earnings that just keep going up, and so do their dividends. Do you, off the top of your head, have any favorite stocks that you like?
We provide our recommendations in our newsletters. One that's come to mind recently over the past few months has been 3M, which most people will know. They do a lot of different stuff. Their Post-it notes are kind of iconic, which is not their main business, but that's just one of the very many things they do. And as you were mentioning earlier, stock market, it's one of the only places where when prices go down, people run instead of buy more. And there's a great Warren Buffett quote that ties in with all of this, where he says, "Whether I'm buying stocks or stocks, I like quality merchandise when it's marked down." So that's what I see 3M as right now. It's definitely a very high quality company. It's actually paid increasing dividends for over 60 years in a row, which speaks to its unbelievable longevity. And it's going through a little bit of a temporary issue right now. It has a legal battle one of their subsidiaries provided earplugs to the US military, and they are allegedly, which probably defective. So there's been a legal battle there, and that's one of the factors that has reduced the share price considerably. But if you actually look into it, it is not threatening to the company like as a going concern at all. It's basically a one-time issue, and those one-time issues can create great buying opportunities.
As we've seen right now, or as of late, definitely. Now, have you noticed if the company has thought about reducing the dividend, or is that something on the horizon?
No, we really don't think that's on the horizon at all. First of all, their dividend is very well covered by their earnings. Second, they have a very long dividend streak, and when the dividend streaks very long, management teams typically want to keep that streak going. You don't want to be the CEO that lost the 60-year streak, and there's no reason they need to stop it. And they don't need to do this, but they have ample room to take on debt if they needed to, or additional debt. Not that they need to, but if there was a cash crunch, they could do that too if there's like a large one-time settlement.
Got it. So this is speaking, only for 3M, but in general, is the dividend usually or always the same with companies?
Oh, I see. It really depends on the company. So there's 3 different ways dividends can go. They'll either be steady. So some companies, these are typically companies that aren't growing, will pay the same dividend year after year. And that's okay. It's not great because inflation actually erodes your purchasing power. So your purchasing power, you're getting a little bit less each year. Or a company can raise its dividend every year or most years. And that's what you want to see, because you're getting more every year and you're not having to put more money in. So that's the ideal situation and what the type of securities we're looking for. And then the negative outcome is the dividend reduction or elimination. And that's where a company will either cut its dividend. So if it was paying $1 a share, it might say, now I'm paying 50 cents a share, or it will eliminate its dividend altogether. And then in that subset, so that's pretty rare. We rarely have companies we recommend cut their dividends, very rarely. We go for safety and quality. And if you invest in companies where they have a lot more profit than they're paying out in dividends, you really reduce your risk of that. And that's one thing we focus on. But even the companies that cut their dividends or reduce them, sometimes it's temporary. A lot of companies temporarily suspended their dividends during COVID lockdowns. So you can imagine that was a period of great uncertainty. And a lot of companies said, we want to conserve as much cash as we can because we don't know when things are going to come back to normal. And then they initiated their dividends again when they had a little bit better idea of what was going to happen. And then other companies, if their business is declining, their profits are eroding, or they're losing money, they're forced to eliminate their dividend because they literally cannot pay it. There's no money available to pay out.
Right. And speaking of which, during COVID, it's what I loved reading about in your newsletter is, the research that was talking about, really all of these companies, about where the direction was going, sort of setting me at ease, knowing that, the business is still there, life is still going to go on. And that these companies, the dividends were actually safe, and they were. And now they've gone on to grow the dividend, and that's what dividend growth investing is all about, right? Getting into companies that are going to be increasing their dividend, kind of like getting a raise. And, a lot of these companies, they've raised their dividends for, 25, 35, 50 years, 60 years in a row. I think there's some that are a little over 60 years. There's not many, but there's a couple. And definitely. So talk to me about taxes on dividends. So you've got these dividends coming in. How does it work, for the average American, having to pay taxes on these? Like, how does that work?
Absolutely. So first of all, tax situations can be tricky. So always consult a qualified tax professional. But in general, most companies' dividends are taxed as qualified dividends. So you don't pay your ordinary income rate on those. you pay the qualified dividend rate of 20%. It depends. The max is 20%, which, it depends on your other income and tax situations and marriage status and so on. But 20% is the qualified dividend tax rate. And then if your dividends are in a retirement account, depending on the retirement account and situations, typically retirement accounts are tax-free at some either money you're contributing or money you're taking out, but you can compound tax-free. So the dividends paid inside your retirement account typically are not going to be taxed while they're in there.
Interesting. So do you think in general, I mean, I'm not speaking specifically for anyone, everyone's needs are different, but in general, do you think that dividend stocks should be held in retirement accounts, or should they be in taxable accounts?
If you have the choice, a retirement account is better because there's less taxes, so more money to in your account to compound for you.
Great. And in general, how much of any stock would you say someone should own? Like, how many dividend stocks should you have as part of your portfolio?
That's a great question. So no one can tell the future. And even if you do all your research and you find great companies, something could happen. So you always want to diversify. And that just, means don't put all your eggs in one basket. Don't put all your money in one stock. We like portfolios of 20 to 30 stocks. There's a trade-off. The fewer stocks you own, the more you can concentrate on your best ideas. But the more stocks you own, the less risky it is because you're more diversified. So we feel at Sure Dividend that a 20 to 30 stock portfolio is a kind of a happy medium between the concepts of concentration and diversification, because you're still investing a good amount into your favorite companies. And 20 companies, you can be familiar with them. 500 companies, you're not going to know what you're investing at all. Like that's just, you can't know 500. So it's easier to follow at the 20 to 30 range. And you're still getting almost all the benefits of diversification. The benefits of diversification trail off. So the gains from going from one stock to two are enormous, but going from 499 securities to 500 you get almost no extra diversification there.
Sure, no, that's a great answer. And when someone is itching to sell, when is the right time to sell a dividend stock?
That's another really good question. And there's no easy answer. There's different ways to think about it. But what we like to do is think about the reason we bought the stock in the first place, and that's to get dividend income and growing dividend income. So if the company reduces or eliminates its dividends, we like to cut it there, typically, depending on the situation. But in general, removing companies that are decreasing their dividend is one sell criteria. And then if the company is unlikely to generate solid returns ahead, and that's a more nuanced discussion. It's not as simple, well, is the dividend cut or not? But it goes into valuation and growth. And if the valuation is too high and or the growth rate's very low or may even be negative, you might want to sell and invest the proceeds into a better opportunity.
All right. So what's next for Sure Dividend? I know you guys have something that you wanted to offer our viewers, and you didn't tell me what it was before. So I am excited to hear about it.
Yeah, absolutely. So I wanted to offer financially independent millennial readers access to the Dividend Ideas Plan, which includes our top 10 Dividend Elite service, as well as our top 10 REIT service. But the top 10 Dividend Elite service is something we've talked about a lot in this call. And for your readers and watchers of your channel, we wanted to offer a $32 a year discount. So that reduces your price from $99 a year to just $67 a year. And you can access that in the links below in this, or the coupon code to use is FIM32.
That is great. Well, I'm definitely going to check that out. And as Ben said, the links are in the description below. And if you haven't already done so, by the way, please go ahead and hit that subscribe button. That way you never miss any of our future videos. Ben, have I forgotten anything on this call? I mean, you've been a wealth of information. Is there anything more that you wanted to talk about related to investing in dividend stocks?
We've covered a lot of topics. It's something I could talk for hours about. I would like to close with, I touched on this snowball, and I'm not talking about winter weather when I say that. I just wanted to touch on that core concept in dividend growth investing, which is to tie everything together, which is think of your investment account as a snowball rolling downhill, and it's picking up snow as it goes. And that's you're investing money in a stock. That stock is paying you dividends. You're putting those dividends back into your portfolio, buying more stock, and then those stocks are paying you more dividends per share each year. So you get multiple levels of compounding to really grow your wealth or grow that snowball as it rolls downhill.
Great information. So then at that point, you don't even care how much the price of the stock is. All you care about is the amount of money that's coming into your account every single month.
Yes, absolutely. The seeing the money come in is a much better thing to watch than the stock price, which just bounces around so much.
This is great advice. Ben, this has been wonderful. Thank you so much for joining.
Thanks for having me, Rick.
All righty. Take care.